how to find them, how to fix them, how to flip them, how to get your credit right if you want to buy it as an investment or buy it to live in. I'm going to share with you in this episode everything you need to do to look for foreclosures, especially HUD foreclosures. Now, HUD is for housing, urban development, and that's where someone got an FHA loan on a home to purchase a house just like this one. And unfortunately, they fell on hard times. As a result, the bank took the property back. When they take the property back, they make it available for sale for you. Now, if you're not going to be buying with cash, you need to get your credit right. And most people aren't buying with cash, they're getting a mortgage. And to get a loan on a home, you have to have a 620 or higher credit score. That's pretty much the basis point. So I tell everybody, pull your credit at creditkarma.com, or you can go to myfico.com. You want to make sure you look at a tri-merge credit report, and that's Equifax, Experian, and TransUnion. Those are the 3 credit reporting agencies. Once you go to those websites and pull your credit, if it's below 620, scan over everything and make sure there's nothing on there that could be removed that's not yours. And that way you can click a little button and contest it. These properties getting approved, qualified, it used to be a long, lengthy process. Now you're just a click away and perhaps 30 days away from buying a home. Now, please understand me and hear me out on this. There's a big difference between being approved and being qualified. Being approved means they've pulled your taxes, they verified your income, they pulled your credit, they made sure you got a little money in the bank. But if you don't have money in the bank, I'm going to share with you here in just a second how to buy a house for no money out of pocket. That's an approval process. They're going to basically give you a piece of paper that says you're good to go. That's like having cash, and you want to do that. Now, the qualification process, they don't verify anything. You're just calling a lender. You're talking with somebody on the phone, either at a credit union or mortgage company, a bank, local small town bank, and they'll say, yeah, you should be fine, but they haven't pulled your credit or anything like that. So you want to make sure, and listen, they don't charge you anything to do this because they make money when you get a home loan to buy a home. So they're incentivized to take good care of you. They don't charge you to get approved. Once you're approved and they give you that piece of paper, it's like having cash, because once you make an offer to purchase a house, you're going to submit that piece of paper with your real estate agent, and your real estate agent's going to give it to the seller or the seller's agent. And that's like having cash. That's showing them that you have been serious, you've been approved, you're ready to go, you set a closing date. And on these HUD foreclosures, you can close in 2 to 3 weeks. Now, it's important to know the day that you close, you get the keys and it's your home, it's your responsibility. But you also have to know that you got to get with a good real estate agent and a good mortgage lender so that they can work with you as far as what you're going to be paying in taxes and what you're going to be paying in insurance, and they start your escrow account. Now, an escrow account is where you pay one payment each month, and your mortgage company will pay your taxes and pay your insurance. So you never have to worry about being behind or being late or anything like that lapsing. Really quick, I'll explain to you why they do that. They do that because they don't want you to fall behind in your taxes. You see, if you were to not pay your taxes, and let's just say your taxes are $3,000 a year, if you don't pay your taxes, your city, local, parish, county, they can actually foreclose on the home. That's true, that's right. Your city taxes, your property taxes, I know it sounds crazy because it's like, oh, let's pay off my home, I'll own my home. I own it now. But unfortunately, you still have to pay your local government taxes. And if you don't pay your taxes, whether you have a mortgage or not, they can take your home. Now look, don't blame me. I didn't make the rules, and I certainly don't like it. I think personally, and Florida's talking about it, to remove all property taxes. At least if you're over the age of 65, you shouldn't have to pay property taxes. We pay taxes on absolutely everything. It's ridiculous. But it's important to know once you purchase that home, it is yours and your responsibility. However, before you purchase that home, you have to know that you can and should always get a home inspection on the property. By doing a home inspection, it gives you peace of mind knowing that after you've closed, at least you've done an inspection on a property. It's also important to know that these foreclosures are being sold as is, where is. The bank's not going to make any repairs, but it still doesn't mean that you can't do an inspection for your own cognitive purposes to know that, okay, there is busted pipes, and I don't want to buy the property anymore. Because you can make an offer on a property and buy it for full price because there's multiple offers, right? Well, if you do that and you find that there's busted pipes, you can cancel the contract, get your deposit back, and go on to the next home. And believe you me, what has happened, will happen, should happen, could happen, will happen. I've seen it all. I've been doing this business for 29 years. If you haven't already done so, subscribe to the channel. My name is Wayne Turner. I bought, flipped, built. I've helped thousands of people purchase their homes. And I just shared that with you so you can have the confidence knowing that what you learn from me is from actual tried and true, boots on the ground, hands-on experience. Give us a thumbs up, subscribe to the channel, but there's more. You see, before you even make an offer on a home, or even a piece of land for that matter, there's nothing wrong with getting out on an afternoon like today and going over there and talking to the neighbors and seeing those neighbors. And you'll want to ask them these questions. Write this stuff down if you haven't already. Is this property in a flood zone? Has it ever flooded in this area? Have you ever had any trouble with neighbors? What about the crime? What about the school districts? Are there any kids in the neighborhood? What do you like most about this home? Would you purchase your home? Do you own your home? The answers to those questions can absolutely make or break whether or not you even want to make an offer on that home. And the good news is that it's free. Here's another one, and it's free. You look at this house, one thing that people never typically get is a survey. They're like, well, I don't need a survey, Wayne. There's a telephone pole and a telephone pole. Isn't that it? Well, yeah, it could be, but what about these woods? Does the property stop? Here's the house, and here's the woods. And I've seen it many a times where those woods are actually encroaching, so you're cutting somebody else's grass. Or what about the fence? What about that storage building? Is that storage building on this property? So you need to know those things going in. That way you can, one, address it with a seller if you're buying from an owner, or if it's a bank-owned property, once again, you can address things like that with them. Because if there were to be a storage building or shed or encroachments, banks are pretty good about saying, hey, there's an encroachment on the property. And an encroachment is when the neighbor has something on the subject property that you're looking to buy. It's encroaching upon your property. If it's encroaching upon your property, it's better to know that before you buy the property than after. And once you do that, the homeowner, the bank, they can contact the homeowner of the adjacent property who's encroaching and have them remove it, not you. Now, as I'd mentioned, you want to have the property inspected, but not just a general home inspection. It's always a good idea to find out whether or not the property is on a well or a septic system. If it's a foreclosure, they'll disclose. Homeowners know and they disclose, so you know that going in. That's also another thing that you can walk around and ask the neighbors. Oftentimes, these foreclosed properties have sat vacant for sometimes 2 years, and they'll go through and winterize the property after they've been placed on the market for sale. But you don't know how long the property's been vacant. And if it's been vacant during the winter months and it's gotten below freezing, those pipes will bust. When the pipes bust, you have water everywhere. When you have water everywhere, and all of a sudden here comes springtime, you got mold growing everywhere. So you never know if the home has sat vacant, pipes have bust, and mold has grown behind the walls. And listen, the septic system, the well system, most banks will check those out. They'll have those inspected and give you a certification, because you have to have that certification in most counties, parishes, in order to get the utilities turned on your name. That's the way they kind of govern to make sure septic systems stay up to par. But you always want to know that before you close on the home instead of after. Now, if a property is in a flood zone, it is not the end of the world. Just because it's in a flood zone, it's going to be in A, B, or C flood zones, and there's variations of A. C being the best flood zone, and more than likely, that property may have not ever flooded. But when you buy a bank-owned home, they've never owned the home, and so there's no way to disclose that. So they don't have to disclose, because bottom line, they don't know. And that's why I say get out and ask the neighbors, talk to the neighbors. Has this area flooded? Has that home ever flooded? You'd be surprised how someone will say, yeah, that home's flooded twice, even though it's in flood zone C. Just because you're in the lower flood grade, if you will, as C, that still doesn't mean that that home is not flooded. And maybe perhaps it's flooded. If it's flooded once, chances are it may flood again. You just don't know when. Now, one of the most common asked questions that people ask me is, Wayne, how do I buy these houses for little money out of pocket or no money down? So there's a couple of ways. If you buy a foreclosure and you get what they call a hard money loan, it's still going to cost you some money out of pocket, but here's how a lot of people buy and flip these houses. They go to a private lender, a hard money lender. You can just Google hard money loans. They're going to charge you anywhere from 10 to 15%. And before you go, what? You have to consider this. It's not so much the cost of the money, it's the availability of the money, because it's temporary. Because you're going to buy that house, you're going to maybe put 10, 20% down, and by putting 10, 20% down, they're going to loan you the rest. They're going to put a lien on the property. So they're going to be the person that basically is the owner of the property, part owner of the property. You're going to fix the property. After you fix it, you can turn around and get that refinanced and pay them off and get a full 15, 30-year mortgage on the property. Now, to buy a home like this with little to no money out of pocket, you're looking at a USDA loan. Now, a USDA loan stands for United States Department of Agriculture, and you can buy foreclosures with those types of loans. However, you're going to have closing costs, and many times banks will not pay your closing costs. Now, the closing costs are going to run you around 3.5%, and if the bank pays that, and you get a USDA loan, which is 100%, all you need is money for an appraisal and an inspection, and that will run you around $400 for an appraisal and around $500 to have it inspected. Now, for such a loan as a USDA, you're going to need a 620 credit score or higher. You're going to have 2 years on the job. They're going to verify your income. You don't have to have a whole lot of cash in the bank. However, you do have to have that 620 or higher credit score showing proof. And they also are going to look at your debt to income ratio. So they're going to look at, okay, here's how much money is coming in, and here's how much money you have going out. And a good rule of thumb is what we call the 29% rule. So they are going to loan you no more than about 29 to 30% of your gross income, your adjusted gross income. Now, for example, if you get an FHA loan and you're self-employed, they're going to look at your adjusted gross income. If you work for someone and you get paid every month or every 2 weeks, they're going to look at your gross income before taxes. They'll also subtract what you have going out, like car payments, minimum credit card payments, student loan debt on a monthly basis, and you're left with what they call the adjusted gross income. They will loan you 30% of that on a monthly basis of that money to go towards your mortgage payment. And listen, I know that seems very complicated and kind of confusing, but just know this, it's not as hard as it may seem. One, check your credit, pull your credit, Equifax, Experian, TransUnion. Those are the three. You can do that at freecreditscore.com, Credit Karma, MyFICO. Google those. You may have to pay for it. I think it's crazy that you have to pay for your credit score, but listen, it's not the end of the world. If you have to do it for a month or two and it costs you 30, 40 bucks to do that, at least you know, because if there's something on your credit report that's not yours, had it happen, you can contest it and they will remove it typically within 30 days. It's removed off your credit and it bumps up your score. Another good thing that's coming down the pipeline is they're about to literally wipe and erase all medical bills and debt that are on everybody's credit report, because literally there's some 15 million people in the United States that have debt to medical bills that's on their credit, and it's affected it in a negative way. The good news is all of that's about to be wiped off. So look, get your credit right, get you about $1,000 bucks, 620 or higher credit score, you can buy a house just like this one. You are limited on your income. So if you make over $110,000, typically that's the income cap. So if you're making $150,000, then the USDA won't work. However, you can get that credit score up. Once you get the credit score up, it's important to know you can get an FHA loan. You can get an FHA loan in most areas, and the maximum amount is $524,000 and some change. $524,000, you get an FHA loan. Now, you will have to pay what they call private mortgage insurance on that. The negative part about an FHA loan is it doesn't cost you as much in terms of down payment. You only need 3.5% to put down. The seller can pay your closing cost. And it's a little less strict when it comes to credit and debt to income ratio as well as income. But you also have to know this, you're going to pay private mortgage insurance. That's an insurance policy that the bank takes out on you in case you default on the loan. It kind of covers them, and you have to pay that monthly premium. When you get an FHA loan, it's on there forever. You can't get it off unless you refinance the property in the future to a conventional loan. At that point, you want to make sure that you refinance it on a conventional loan once you have 20% equity in the home. So look, I hope I didn't bore you with this video. My ultimate goal in life right now, I've been in this business for 30 years, and I believe that you learn it, you master it, you teach it. Doesn't matter your craft. You're a carpenter, you're a doctor, you're a mechanic, you're an accountant. You learn it, you master it, you teach it, and you pass it on. I'm Wayne Turner. Give us a thumbs up if you like these videos. Leave a comment, ask us questions, subscribe to the channel. Until next time, God bless you.